studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that some kid died.
In the previous section, we explored situations where a family member may want to participate in employment insurance in order to qualify for future benefits. However, there are also situations where a family employee may decide that paying EI premiums is not worthwhile. Understanding when this decision is appropriate is an important part of payroll planning. Choosing not to participate in employment insurance is not simply about reducing payroll deductions. It is a planning decision that requires careful consideration of both the short-term savings and the long-term consequences. Once a family employee is exempt from EI, they generally will not be eligible to receive EI benefits if they later experience unemployment or need certain types of EI coverage. The decision-making process should always begin with a discussion of the individual's goals. Some family members may value the protection provided by employment insurance, while others may believe that the cost of EI premiums outweighs the potential benefits because of their personal circumstances or the nature of the family business. If the family member believes that future EI benefits are important, they may choose to participate in the EI program, provided the employment qualifies as insurable under the applicable rules. On the other hand, if they determine that EI benefits are unlikely to be needed, they may wish to explore whether an EI exemption is available. Before reaching that conclusion, several important factors should be reviewed. First, confirm that the employment relationship meets the applicable CRA requirements. Next, consider the family relationship between the employee and the business owner, since related party employment is subject to additional rules. Review how payroll has been established and ensure that the payroll treatment is consistent with the corporation's ownership structure and the individual's employment status. It is equally important to think about future needs rather than focusing only on today's payroll savings. Ask questions such as, could the employee require parental benefits in the future? Might they need sickness benefits or other employment insurance programs? Would giving up EI coverage today create financial challenges later? These are important planning considerations that should be discussed before making a final decision. The CRA rules must also be respected throughout this process. An EI exemption cannot be claimed simply because someone prefers not to pay premiums. The employment relationship and payroll treatment must satisfy the legislative requirements, and the corporation should maintain documentation supporting its decision. Professional advice plays an important role here. A CPA or payroll professional can help the family evaluate the costs and benefits of participating in employment insurance. Review the ownership and employment structure, explain the applicable CRA rules, and recommend the most appropriate payroll treatment based on the family's objectives. Perhaps the most important point to remember is that choosing not to pay EI premiums also means giving up future EI benefits. While the employee may save money on payroll deductions today, they may not have access to EI benefits if they need them later. This trade-off should always be understood before making a decision. The key takeaway from this slide is that opting out of employment insurance should never be an automatic choice. It should be a deliberate planning decision based on the family's goals, future benefit needs, the nature of the employment relationship, and compliance with CRA requirements. Good payroll planning balances today's savings with tomorrow's financial protection. Before deciding not to participate in employment insurance, a family business should carefully evaluate whether an EI exemption is actually appropriate. This decision should never be based solely on reducing payroll costs. Instead, it should be supported by a complete review of the employment relationship, the ownership structure, and the family's long-term objectives. This planning process usually begins with a discussion between the family and their accountant or payroll advisor. rather than asking, "Can we avoid paying EI premiums?" The better question is, based on our circumstances, what is the most appropriate payroll treatment under the CRA rules? Professional advice helps ensure that the decision is based on facts rather than assumptions. One of the first factors to evaluate is the family relationship. Since related employees are subject to different employment insurance rules than unrelated employees, understanding how the individual is connected to the business owner is an essential starting point. The next consideration is ownership. Does the employee own shares in the corporation? If so, how many voting shares do they own? Ownership can influence whether the individual controls the corporation and may affect the application of the employment insurance rules. Corporate control is another important factor. The CRA considers who has the authority to hire employees, determine salaries, approve payroll, and make significant business decisions. An employee who exercises substantial control over the corporation may be treated differently from someone who simply works for the business. Payroll costs are also part of the discussion. Choosing not to pay EI premiums reduces payroll deductions and lowers employment costs for both the employer and the employee. However, these savings should always be weighed against the potential loss of future EI benefits. This naturally leads to another important question. Could the employee need employment insurance benefits in the future? For example, they may someday require parental benefits, sickness benefits, or other forms of EI assistance. Giving up EI coverage today could eliminate access to those benefits later, making this an important part of the planning conversation. The CRA will also consider whether the payroll treatment is appropriate if the corporation is reviewed. Employment records, ownership information, payroll files, and corporate documentation should all support the decision being made. A well-documented file demonstrates that the exemption was carefully considered rather than automatically applied. After evaluating all of these factors, the outcome generally falls into one of three categories. In some situations, the facts clearly support an appropriate EI exemption. In other cases, additional analysis may be required because the ownership structure or employment relationship is more complex. Finally, if the payroll treatment does not comply with the legislation, the corporation could face payroll adjustments, interest, and penalties if the CRA determines that EI premiums should have been deducted. The most important lesson from this slide is that an EI exemption should always be a deliberate planning decision. It requires a careful review of the employment relationship, ownership, corporate control, payroll costs, future benefit needs, and CRA requirements. Good payroll planning is about making informed decisions that balance immediate savings with long-term financial protection while remaining fully compliant with the law. This final slide brings together the complete payroll planning process for family employees who are considering whether to participate in employment insurance. The objective is not simply to reduce payroll deductions or maximize benefits. Instead, the goal is to make a well-informed decision that reflects the family's circumstances while remaining fully compliant with CRA requirements. The process begins with one important question. Does the family employee want employment insurance benefits? If the answer is yes, the planning process is relatively straightforward. Assuming the employment qualifies as insurable under the applicable rules, the employee participates in the EI program. Payroll deductions are made, and the employee may become eligible for future EI benefits if all eligibility conditions are met. If the answer is no, the process does not simply stop. Instead, a more detailed review begins. The accountant first examines the ownership structure of the corporation to determine whether the employee has an ownership interest or exercises significant control over the business. This is followed by a review of the employment relationship to determine whether the individual is genuinely employed under normal commercial conditions. Next, the CRA rules are considered to ensure that the proposed payroll treatment complies with the legislation. Only after reviewing ownership, control, family relationships, and the nature of the employment can the accountant determine whether an EI exemption may be appropriate. Throughout this process, the CPA plays a valuable advisory role. Rather than making the decision for the client, the accountant explains the advantages and disadvantages of each option, reviews the available documentation, evaluates payroll records, and helps the family understand both the tax and payroll consequences of participating in or opting out of employment insurance. Good payroll planning also follows several best practices. The family should discuss their future financial goals and benefit needs before making any decisions. The final decision should be documented and supported by appropriate payroll records. Ownership and control should be reviewed carefully because these factors often affect EI eligibility. Payroll calculations should be verified for accuracy, and all CRA guidance should be followed when establishing or modifying payroll procedures. There are also several common mistakes that should be avoided. Never assume that a family employee automatically qualifies for an EI exemption simply because they are related to the owner. Do not ignore ownership or corporate control when making payroll decisions. Avoid poor record keeping or missing documentation, since these weaken the corporation's position during a CRA review. Finally, ensure that payroll is established correctly from the beginning, because correcting payroll errors later can be both costly and time-consuming. A professional payroll planning process follows a logical sequence. It begins with a discussion of the client's objectives, followed by evaluating the available payroll options. The decision is then documented. Payroll is set up correctly. The arrangement is reviewed periodically, and ongoing compliance with CRA requirements is maintained. This systematic approach helps prevent problems while ensuring that payroll remains aligned with both the family's goals and the legislation. The most important lesson from this section is that employment insurance planning should never be based on assumptions or short-term savings alone. Every payroll decision should balance today's cost savings against tomorrow's financial protection. When supported by careful analysis, proper documentation, and ongoing professional advice, the family business can establish a payroll system that is both tax efficient and fully compliant with CRA rules.